The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Who needs Nvidia when you got everything else? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Happy Monday.
Happy Monday. Is it happy
you're sad?
Monday? Well, I don't know. We had a bit of a rally in our hands, but I don't know. They're kind of struggling right now at the waterline.
It is. If you're long Nvidia, it's not that happy for you. All right, let's get to a check-in here on where markets are. The S&P is going nowhere fast, so put that aside for just a second, because underneath it is really quite interesting. The stocks index led lower by Nvidia, for example, Supermicro, AMD, that down by over 2%. So that's really weighing on the overall index. On the flip side, though, the energy sector very much outperforming because you have crude finally outperforming, getting a bid up by about 1%. And just to check in here on that dollar yen, we were looking at 160 despite the top currency official talking about how they would have to step in and maybe intervene at any time when you get to that 160, but that didn't really wind up helping any. Nevertheless, worthy to pay attention of that dollar yen remain.
Interesting price action on the S&P and really shows you the power of Nvidia, because right now, despite the S&P being flatlined, about 400 of the S&P 500 stocks are actually in the green. That's potentially setting us up for the broadest advance since March 27th, when about 91% of the index rose. The S&P Equal Weight Index today outperforming its cap-weighted big brother for 4 straight sessions now, a tinge of optimism that the rally can go on even without Nvidia. Here's Keith Lerner at Truist.
Well, all year long, people have been waiting for a broadening theme. I think there might be some more convergence, meaning if tech's going to consolidate a bit, maybe some of these other areas start to do a little bit better.
And that might actually be the true test of the market's rally. That one stock, as we know it, is responsible for 30% of this year's S&P gains. That one stock, Nvidia, though, has slid more than 11% since its last record high on June 18th. And that includes a 4% drop today, one of only 2 days this year that Nvidia has underperformed the broader market to such an extreme. Now, another trade out there that we're keeping an eye on that's lost a lot of steam is crypto. Bitcoin coming off 2 straight weeks of losses with a potential test of support around that 60,000 mark. The failure to set new highs after that halving back in April are really pushing outflows from Bitcoin investment products up and out. $1.2 billion over 2 weeks, the most since the U.S. ETF approvals in January. Alex.
All right, let's get back to those two first stories, right? The overall market as well as Nvidia. And this is a chart that kind of sets you up. So first you have this green line, which is Nvidia's share price, and the white line, which is the ratio of the S&P equal weighted index versus the S&P. So the higher it goes, the better the equal weighted index is doing versus the S&P. The lower it goes, the more the S&P is outperforming. And this is what we're seeing right now. You have Nvidia falling, therefore the S&P winds up giving up some of its gains, but the equal weighted index giving an opportunity here to move higher. And so the question becomes, is life without Nvidia actually that bad? Does that money kind of go out of stocks and do other areas of the market within the S&P, or does it just leave the S&P altogether? Or, Romaine, is this all just end of quarter rebalancing? Let's just wait till next Monday when things pick up.
Yeah, that's a big question here as we kick you off to the close here on this Monday afternoon. Jason Pry joining us live on set right now. He's the Chief of Investment Strategy and Research over at Glenmede. And Jason, you've probably been busy over the last few weeks, as I'm sure all those questions Alex was asking me, I'm sure your clients have been asking you. Do you have an answer?
Well, when are we not busy? I mean, in reality, this is a pretty robust market environment that we've been through, Romaine. This question comes up quite often from our investors, right? These stocks have gotten to be a very large portion of the market, and people wonder what should they do with that environment. Should they actually own more of them? Should they own less? Our approach has been remain diligent in rebalancing your portfolio. When these particular stocks are up a lot and the rest of the market is not, there is another 493 stocks in the S&P 500 that you should own a good portion of. Rebalance back into those, take the winnings, push into the ones that have been lagging behind, and know that market naturally rebalances over time. Doesn't mean sell it all, but rebalancing can actually be a very good investment discipline.
Do you think we're going to see, though, that type of conviction? I mean, you understand the fear on the market, right? I mean, what works is what everyone chases after, and what's worked so far has been Nvidia and big tech. It's going to take a lot for people to say, okay, let me dip my toe into the water of all those other 400 plus names.
I agree, but I disagree. Right? Every market has these situations where investors want to chase the winners. That's a natural tendency in markets. At the same time, there is a lot of opportunity that exists on the other side, and investors will eventually look at it. And an example of every economic cycle and innovation cycle we've been through shows that we have often seen periods of hype, followed by rounds of disappointment, followed by eventual rounds of actually meeting those previous expectations, often on a delayed pattern relative to what was originally expected, which provides opportunity for investors. Investors will see at some point in time those excess valuations as being an opportunity to shift that money into lower valuation items that will then participate longer term.
Where?
Look, the rest of the 493 stocks actually is a really interesting starting point, even just a broad basket of them. When we've had past technological cycles, we have found that those other companies actually feed off of and implement the technology, creating efficiencies in their business and actually driving the overall market and economy higher. It's interesting to see that following the internet bubble, if you actually look at from before the run-up, the best performance or almost equal performance actually came from the other sectors in the economy, other than the technology, for about a 10-year cycle, which is fascinating and provides a lot of opportunity.
So it begs the question, like, is that a small cap thing or a large cap thing? Mike Wilson said that any rotation will be limited because we're going to start focusing on growth rather than inflation. And that means it's still going to be high quality and large cap, not the riskier small cap and value names. What do you think?
I agree that we always focus on growth, but growth can exist in different pockets of the marketplace. We've been focusing on, again, that other 493 stocks within the S&P 500, not getting rid of the 7, just making sure we diversify. Number 2, owning smaller capitalization securities. That valuation sits considerably more reasonable. We think the back half of this year, if you look at the projections, analysts are actually expecting small cap earnings to catch up with the S&P 500, which is kind of an interesting phenomenon we haven't seen for about 2 years. And then internationally, I think there's some interesting opportunities. Behind the scenes, Japan has been generating just as much earnings growth as the S&P 500. On the whole, Japan is considerably more discounted in valuation and has just as much growth opportunity and actually just as much attachment to artificial intelligence as we do.
We've heard that from other guests here. For those folks who want exposure to Japan, do you recommend more of, I guess, just a broad basket approach to it or something more strategic?
Broad basket works. Strategic can also work as well. We'd say that it's very important to use a diversified investment manager in that space and one that is actually in tune with Japan. If you don't have the right manager to use, I can tell you I'm not a Japanese stock picker.
Yeah.
Broad market exposure will do the job for you.
So it gets to a broader question, though, too, as we start to see a lot of U.S.-based investors look to other parts of the world for value. It's not always easy to do that, to invest directly in those companies. Obviously, you have ETF products here in the U.S. that allow those types of vehicles, or if you're a high net worth individual, obviously you have access to more strategic funds. Give me a sense here of where those people should go or what they should look at if they want that exposure, or do they just look to U.S. stocks that maybe have a large presence in those countries?
So we don't think that a U.S. stock portfolio is the only thing that an investor should be doing. We think a portion of the allocation should be generally in international stocks. We've actually found that between 20 to 30% of a total portfolio for a U.S. dollar-based investor should be invested internationally. And you might think about that and say, well, wait a second, isn't like 45% of the broad international, global market international? Why are you actually down from that? Well, if you're a U.S. dollar-based investor, majority of your obligations are in U.S. dollars. You're exposing yourself to currency risk. But doing that up to a degree makes sense because it diversifies you. Over a certain line, actually over-diversifies you, and you're taking currency risk that you shouldn't otherwise take.
Before we let you go, the other top story today is what's happening in Bitcoin and crypto. Is this part of, you laugh, but is this part of your portfolio at all in alternative assets?
At this point in time, Bitcoin and crypto is not a portion of our portfolio. We continue to think that that asset class is just too volatile when you mix it in with other asset classes. It doesn't make sense. Anytime I've tried to look at something like that as part of a portfolio, it has too much volatility for the return that it adds to a portfolio.
Yeah, all right. Great stuff, Jason. And we should point out, Bitcoin actually did breach that 60,000 level here today, a line in the sand for a lot of traders. A broader look at the markets with Jason Pride, Chief of Investment Strategy and Research over at Glenmede, as we count you down to the closing bells. In just a second, we're going to sit down with Sharma, the chairman of Rockefeller International and founder and CIO over at Breakout Capital. His thoughts on the future of capitalism and how the U.S. elections could impact the markets.
Plus, in our top calls, green on the big screen, shares of movie theater operator Cinemark rally after an upgrade from Roth MKM. We're going to talk to the analyst behind that call.
It's that time of the year to go to the movies, time of the year to start traveling as well, but airfares remaining sky high as we head towards the July 4th holiday. A discussion with Clint Henderson over at the Point Sky. All that and more coming up in just a bit. This is The Close on Bloomberg. All right, some breaking news that just crossed the Bloomberg terminal. The U.S. Federal Reserve has recommended potential changes that could walk back key provisions of the Biden administration's landmark bank capital proposal. Katanga Johnson is in our Bloomberg's Washington office with more details on this. Walk us through this, Katanga. What exactly is the proposal?
The state of play right now includes what's known as a term sheet, a document that the Fed has circulated to other regulators who have to vote on the plan to say what potential changes could be across various aspects, but particularly the component of the proposal that relates to market risk. We know that it also will address potential changes to operational risk, which was a key part of the pushback that a large swath of banks had said that they wanted to see undone. And generally, while there aren't any specific targets that the Fed has made, sources that we've spoken to say that if all the changes in this term sheet were to take effect, we could see a hike of at least or as low as 5% as opposed to the 16% across the board.
Katanga, we look at the individual bank stocks and just looking at the big banks, they were already all up, but Citi, Goldman Sachs, Morgan Stanley, all kind of moving materially higher. Do we know what the difference would be for them, how much more money they could keep or lend, et cetera?
It's very interesting. Those banks are key to this particular market risk component. Again, there are other changes, but we're told that banks with large trading desks are likely to see changes to the aspects of the proposal tied to how they evaluate risk, particularly around their internal modeling. But we don't know exactly what the hike would be for the largest banks, which I think it was 16% across the board, but as high as 19% was the proposal for the biggest banks. That's yet to be seen. There haven't been any agreements among the three agencies. In fact, there is consternation among them about how far is too far. But broadly, these are changes that they are hoping they can get across the finish line if they were to complete this plan by the end of the year.
All right, Katanga, thanks a lot. Really appreciate Bloomberg's Katanga Johnson joining us there on that breaking news. And there was also big news today in the world of hedge funds. Bobby Jane has gathered $5.3 billion in commitments for his new multi-strategy fund called Jane Global. It is the biggest fundraising debut since 2018. It's expected to start trading July 1st. Bloomberg's Hema Parmar has been covering this story and joins us now with the details. Tell us about the environment with which this is going down. And is any of this surprising to you?
Yes, it is a very difficult fundraising environment, and there's a few things that are building together that has made it more challenging. You're looking at interest rates that are higher, which means that the bar for hedge funds to impress investors is a lot higher too. You have to beat the risk-free rate. You're seeing private equity distributions be slower, so investors have fewer dollars to put to work. They're a lot more mindful of where they put every single dollar. You're looking at competition amongst the big multi-strategy funds. You're looking at competition from private credit. So all of these dynamics making it harder to gather each dollar. Yeah. So $5.3 billion is a sizable launch in this environment.
Yeah, and he had originally wanted to raise more than that, but still
Correct.
Pretty decent. I want to talk about this chart, though, on the screen, which kind of breaks down the strategy. I thought this multi-strategy model was kind of struggling. Well, I mean, why is he going to get this right, I guess, when others are getting it all wrong?
Yeah, no, that's a very good question. Multi-strategy is when you invest in all these strategies at once, at the same time. What he's trying to do is really launch a fund that does all of this at the same time.
Yeah.
And that requires building out credit and equity and quant.
Yeah.
That requires, he's focusing a lot on arbitrage, which is when you bet on the spread between different things. So like SRTs, index rebalancing, fixed income relative value, these kinds of trades. So I think, investors are going to be watching for performance very closely as this fund gets gearing up.
Does he have the staff to do that, though? I mean, that's a lot of tactical stuff. I mean, that goes beyond just his own brain power. He's got to have the people behind him to execute all those
Absolutely.
trades.
It's definitely a big feat. And I think, he's hired hundreds of people already.
Okay.
He's got about 40 portfolios, portfolio managers sort of hired and on the team. But they've been building out this complex firm. And it's going to be expensive. It is time consuming. Some of these strategies may take a little bit longer to fully be built out and be put to work. So really this first year will be what investors are watching closely.
Who are the investors, by the way?
Yes, so some sizable investors. ADIA, the Abu Dhabi Sovereign Wealth Fund,
that's
is an investor. It's a big investor. You're looking at some of the bank wealth platforms like Goldman Sachs, Morgan Stanley. So really some sizable institutional names when we look at this fund launch, and keep in mind that Bobby Jane was the former co-CIO over at Millennium Management. So there's been a lot of attention, given he was working closely with Izzy as to what he's doing.
Yeah, a great pedigree, and no surprise that he was able to raise the billions that he did. And I guess if it was a different market environment, he probably would have raised more. Hema Parmar's been all over this story for us. Bobby Jane raising $5.3 billion for his new multi-strategy hedge fund. Alex, I am concerned, though, about the market performance, right? Because we've had Hema on so many times. He talks about these other multi-strat managers that are kind of struggling. And I know Bobby Jane's, in theory, kind of cut from a different cloth, so maybe he'll get this right where everyone else got it wrong.
I mean, it also just depends on the macro environment too, right?
Yeah.
Like how you time it and getting lucky in that way. I don't know, but I thought the same thing. I thought multi-strat was dead.
Yeah, well, yeah, except for him, I guess.
Struggling.
Maybe he'll prove us wrong here. I thought the movies were dead too, but apparently people are still going.
Did you see Inside Out 2 yet?
I have not seen it yet. Thankfully, my child is past that stage of their life where I have to go see every animated movie, but it is still the hottest ticket in town. And it's not just the movies, it's Cinemark itself. That's the view according to Roth MKM. It's part of our top calls, and it's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. These are the big movers on the back of analyst recommendations, and we start off with the firm. Goldman Sachs analyst Will Nance assuming coverage of the fintech company with a buy rating and a $42 target. Nance citing the company's differentiated underwriting and vast distribution network, which he says can support sustainable 15% plus growth, merchandise volume growth. The share is higher by about 13.5% on the day. Next up, let's take a look at Carrier, the HVAC company, upgraded to buy over at Citi amid a transfer of analyst coverage. The new analyst saying Carrier has been morphing into a better business by leaning into high-growth areas. That includes heat pumps that use electricity rather than oil and gas. He says this transition should be wrapped up heading into next year, leaving room for further upside in core markets. Those shares having a decent day, higher by about 3%. And finally, let's take a look at SiriusXM, raised to in line over at Evercore ISI. The view that the satellite radio company's in-car subscriber base can stabilize in 2025. The analyst sees improving fundamentals driven by a recovery in used car sales and fresh distribution deals with EV makers. Investors, though, not really liking it today, down about 7% on the shares, 273 and change right now on Sirius. Those are some of our top calls as we stick in the consumer space right now and take a closer look at movies and the box office. A net positive for movie theater operator Cinemark. That's according to Roth MKM. It upgraded the stock to buy from neutral. The man behind that call joining us right now, Eric Handler, media and entertainment analyst over at Roth MKM. Eric, we've all know the movie theaters have been struggling a bit even prior to the pandemic. The pandemic looked like it was going to kill them off, but we've had some big releases this year already, including Inside Out 2 a couple weeks ago. That seems to show there's still an appetite for folks to get back into the theater. Is there going to be something there for them to see?
I think the worst of Hollywood's impact from last year's strike is over. We're going to start seeing a bigger slate of films starting in the second half of the year. We're getting a really good start right now with Inside Out 2, but we'll start next third quarter with Despicable Me 4, then go to Twisters, then go to Deadpool and Wolverine, and then we look into the fourth quarter, and fourth quarter is loaded with, you know, a Joker sequel, Venom sequel, Moana 2, Mufasa. There's a lot there, and then that sets the stage for what should be a very strong two-year content cycle in 25 and 26.
Well, question on that. I hear a lot of sequels in there, and I know this is kind of the Hollywood formula right now, is that once they find something that works, just milk it and milk it. But it also raises the question, Eric, as to why should I go the first weekend or the second weekend to go see this movie instead of waiting, I don't know, a month or so to when it's going to come out on the streaming services? Is there enough incentive to go out and do that?
You know, movies can still create a lot of water cooler buzz. And so for that reason, people do. There's excitement around these movies, and there's good advertising around them. People want to be there for opening weekend and then talk about them on social media and the water cooler. And, it creates a lot of excitement. So, yeah, people still, you can't Netflix and chill 52 weekends a year. And people want to get out of the house. And movies is still a very relatively low-cost form of entertainment.
Yeah, you haven't met my uncle, Eric. He's been Netflixing and chilling for like the last, 52 years, but that's a whole nother conversation.
I will definitely be calling out sick when Deadpool Wolverine comes out. Let's just be clear and put that out there altogether. But, Eric, is it just Cinemark that's going to benefit? Are you going to upgrade all its peers? Like, are there the good and the bad movie chains?
Well, I still like IMAX a lot. IMAX is very different. They're not a theater chain. They're an entertainment technology platform, and it's a global play on the blockbuster movies. I do have a sell on AMC, but that's really more of a balance sheet, lack of cash flow issue. So you're a bit limited in your options right now. So Cinemark and IMAX, I think, are the best ways to play the box office.
Do you feel like we're really going to start to see the stocks move like next year or the end of this year? Like when's that turning point going to be, considering all the movies that are coming out?
I think investors have these stocks on their radar screens now, and they tend to move ahead of the actual box office moves, and people are positioning themselves now. And, both Cinemark and IMAX I view as very inexpensive names. Cinemark, pointed out today, is trading at less than 6 times next year's adjusted EBITDA. Historically, these stocks trade anywhere from 5.5 to 9 times. So still on the lower half of the range. And it's more for Cinemark, it's more than just the box office too. Next year, there's going to be a deleveraging play. They're going to pay off their convertible note in cash. That'll take their leverage, their total debt back down to pre-pandemic levels and net leverage to about 2 times. And from there, I think they reinstate capital returns, bring back a dividend, maybe even have share buybacks.
All right, Eric, thanks a lot. We appreciate it. Eric Handler over at Roth MKM. So I guess, Romaine, you won't be participating in the movie move.
No, I mean, look, you're a parent, so sometimes you get dragged to things that you don't necessarily want to go to. But I don't know. It's a lot of sequels, and I guess I kind of like more original stuff. And I get it. Everyone loves Deadpool 2 and whatever else. I forgot all the other Twister. They're making another Twister.
Deadpool 3. Okay, it's Deadpool
oh my gosh. She's going to kill me.
It's Deadpool, Deadpool 2, and then Deadpool Wolverine.
Deadpool Wolverine. And now, are they fighting each other or are they friends? How is this
They're
work?
frenemies. They went back and they cleaned up the timeline at the end of Deadpool 2, and now they're going to be frenemies.
So now they're kind of working together, but just like begrudgingly or something like that?
Yeah, there'll be some violence between the two of them, and then they'll come together. We know this, right, people? All right, coming up, Ruchir Sharma is chairman of Rockefeller International and founder and CIO of Breakout Capital. His insights on the U.S. elections, should they affect the markets? And how do you think about that headed into the debate this week? This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Taking a look at the markets, it's going to be an interesting wrap-up of the second quarter. It feels like volume's light, the NASDAQ getting hit, but other than that, it's kind of a nothing burger, except Nvidia, obviously.
A little bit. Maybe we are starting to get a little bit of that rotation that everybody says we should have gotten a while ago. They're broadening out at their rally, leaving Nvidia behind with, basically to nurse its, still 150% gain on the year. But, this is, I think, what a lot of people thought could be healthy for the market. And the problem, though, is when you look out forward over the next, 6 months, there are a lot of potential catalysts that could actually knock this rally off its
Exactly. And one of them could actually be this week. And the U.S. election obviously heating up. One of the main events in politics this week is President Joe Biden and Donald Trump debating on Thursday. The first debate attracted in 2020 about 73.1 million viewers, making it the third most watched presidential debate in television history. Do you watch this time? Are you going to watch this time?
Every time these come up, I always say, no, I'm not going to watch. And then I always do.
And then you do. And then you're like, I got to do it for work. Yeah. And then you do. And then you get sucked in. Well, Ruchir Sharma is chairman of Rockefeller International and founder and CIO of Breakout Capital. He also has a new book out called What is Wrong? What Went Wrong with Capitalism? Ruchir, it's good to see you. Thank you for joining us.
Thanks, Alex, for having me back.
So can you just help me understand how markets should be looking at the U.S. presidential election?
Well, the markets are broadly ignoring it, I think, for 2 reasons. One, that they know pretty much what Biden's going to do. And 2, as far as Trump is concerned, it is so unpredictable that the market's almost not focusing on it. And I think for possibly the right reason, because one of the themes that I argue in my book as well is the fact that if you look at Trump's previous track record, on some of the key issues in terms of what he said and what he did were so different. Like, you know, one of the big issues I have with capitalism today is the amount of regulation that this country faces. Trump promised that when he'd come to power, he'd bring down the regulatory state. Said for every two regulations, for every regulation that I put into place, 2 regulations would go out. What was the track record? The track record was that in his 4 years, he put in as many regulations as Obama or Clinton before him, which is basically an average of 3,000 new regulations a year. So I think that that is one of the fundamental problems of America today. The regulatory state has grown so much, such a complex tax code we have got. For every new regulation that you put in, you get thousands of pages of further clarification. And the other issue for America today, obviously, is the debt and deficits. Now, both these leaders don't have any plan to address that. And you have their key supporters who are telling them on both sides that debt and deficits don't really matter. People have been crying wolf on this for such a long period of time. We've had the clocks go up on Times Square. These things don't matter.
Well, that's the thing, is it feels like no matter who wins, 2 things might be the same. The fiscal deficit is going to continue to grow.
Yes.
And there's going to be harsh policies against China.
Yes.
Is that fair? Like, those are like constants no matter who's in the White House?
Yes, but I think that the deeper problem, as I said, is the fact that no one is addressing what the core issues are. That capitalism somewhere has gone off the rails. This is not the system that they had in mind. So, but you're completely correct that in terms of that, for people to get more economic freedom, to deal with the issues of inequality, I don't think any of this is going to be fundamentally addressed by either of the leaders, even though they sort of talk about it. Someone wants to put a billionaire tax. Someone wants to, do that. None of this is really practical. So I think that that's why the markets have been so oblivious almost of the political debate in America.
But it's just getting this sort of winding the knot even tighter. We talk about the rise of Trump back in 2015, 2016. He rode that wave of discontent with capitalism, or at least the current state of democracy and the way it was structured. Now, he may have not offered a solution for that, but people saw a solution in him. We saw a similar thing overseas in the UK and Brexit. Now we have another election coming up there next week. Saw a similar thing going on in Western Europe, and now we have another election happening in 2 weeks over there that are ostensibly not just about the men currently in office, but it's essentially about the previous 30, 40, 50 years of post-World War economic policies.
Absolutely. So that's correct. And I've traced that in the book, as you know, which is the fact that in the last 30 to 40 years, you've seen a secular decline in the approval ratings of leaders around the world, in the Western world in particular. So people are unhappy, and each leader who comes to office gets more and more unpopular, and the probability of the incumbent winning a re-election keeps going down. Like in places like America or much of the Western world, if you were the incumbent or the leader in office, the probability of you winning the next election was pretty high. I mean, at times 70, 80%. That probability has now come below 50%. So it's almost being in office is a disadvantage. And I think that that's why we're seeing so many leaders around the world be unpopular and so many of them lose election. And even that's why today, even though so many people say, oh, under Biden, the economy is done okay, it's growing at 2 to 3%. But most Americans still feel that the economy is moving in the wrong direction.
But what's the solution? I mean, you have a book saying what went wrong with capitalism, but to kind of quote one of my favorite sports analysts, someone says we need to replace this quarterback or that, the question is always with who? So it's easy to say capitalism might be flawed, maybe even broken. But is there something out there, a system out there that could replace it, that would address some of those issues?
No, but what I say in the book very clearly, Romain, is that capitalism did not fail, it was ruined. And what ruined capitalism over the last 30, 40 years is that it's become socialized risk. The risk has totally been socialized. And the people who are most advantaged by this system are typically the rich, which is that you have this culture of bailouts which has come into this country, where everyone thinks that they deserve a bailout. You have this incredible regulatory hegemony, and that is facilitated a lot in terms of by big businesses. Because, when you have regulations that come into place, who benefits? It's the entrenched, it's the big businesses, the big tech companies, they have their lobbyists. So they're the ones who benefit the most from the system.
Has that shown up in the numbers in terms of like new business? Because I've heard this narrative before that the incumbents now are so entrenched that it's actually tamped down new business creation.
Yes, if you look at the number of new startups, last 30 to 40 years in America, it's been declining. Now, after the pandemic, we saw a bit of an increase because, there was an artificial closure of some businesses and some new openings. But generally, the trend in new startups in America has been a 30, 40-year decline. And in America today, the economic and social mobility is at record lows. So there's a feeling out here that there is not an equality of opportunity. See, under capitalism, there was always going to be inequality. But the inequality was supposed to be due to meritocracy. And that was okay by most people. Now there's a feeling that there is an inequality of opportunity because the entrenched and the existing people have such an advantage, given the capitalist system being distorted today, that new businesses being created, the small and medium-sized businesses, they find it very difficult to thrive in this sort of environment, and the average employee feels suffocated. As a detail in the book, there are so many towns in America today dominated by just one company. And then when it's dominated by one company, then the average person virtually has no bargaining power. And so these are some of the deep fundamental issues. And over the last 100 years, as I said, progressively with each decade, these issues have got exacerbated.
All right, Ruchir, going to have to leave it there. Ruchir Sharma, he has a new book out called What Went Wrong with Capitalism, chairman of Rockefeller International and CIO over at Breakout. Yeah, this raises a lot of questions. I don't know, I mean, obviously this isn't going to be solved in our election in November, but it gets to the question that how much longer can we go like this before, I don't know, we just really just go off the rails in terms of who we vote for and why.
I have to feel like writing that book, Ruchir, must have been pretty bumming. That must have been really hard to write a book about how everything was going really wrong.
But as I said, that the first step to a cure is to diagnose the problem.
Sure.
So that's what I've tried to do. And more than anything else, it's an ode to capitalism, saying that, if you give people economic freedom, and I have a whole chapter on that, capitalism works in those countries if you give people economic freedom. But if you take away their economic freedom, you have a very distorted form of capitalism now.
So at least the acknowledgement is the first step to recovery.
All right, well said. Ruchir Sharma there helping us count you down to the close, a broader look here. What's going on in the world, a more narrower look coming up after the break. A look at crypto. The losses continuing, Bitcoin dipping below 60,000 for the first time since May. It's part of our Stock of the Hour. Coming up next on The Close on Bloomberg. All right, it's that time. Time now for our Stock of the Hour, and we're looking at multiple stocks. Watching the digital token stocks having one of their worst weeks so far this year. That includes names like Marathon, Coinbase, and the others here. A lot of cracks right now in the crypto space. Bitcoin dipping below 60,000 for the first time since May. Abigail Doolittle joining us right now to talk a little bit more about this. 59,000 and change here. I don't know. We came off that halving in April, and everybody said we were just going to see, Bitcoin go to the moon, but looks like a lot of that got priced in prior to that.
Yes, I think so. We're also in a range. So the sellers were up there around $70,000, and they did what they have done many times, with not including just this year, but going back, they sold Bitcoin down. So now we're at the bottom of the range. Below 60,000 puts the pressure on 56,500. If below that level, we are very likely to see.
That's the technical level.
That's just the technical level. So if below that level, the sellers are likely to let this thing really drop down to, let's call it 40,000. Now, the reason that's interesting is that's actually the exact level of where an uptrend is for Bitcoin. So when you have two different levels that are coming from separate ways of looking at the chart, it tends to confirm it. You also have the weekly RSI rounding down, telling you that the momentum is not very good. Now, there is an off chance that we'll see Bitcoin go back up into the range, make another try at 70,000. But I would say at some point this year, we're going to see a move down toward that long-term uptrend. Let's call it 40,000. And something that I think is really interesting here is that if Bitcoin doesn't really have big fundamentals outside of the halving, we can look at it as a barometer for risk on, risk off. If the VIX is quote unquote broken, some people have done this. This suggests that we are very uncertain, which is not surprising given the geopolitical situation, the uncertainty around the economy, and also politics and the presidential election.
And also we have Nvidia down too. And I'm wondering how much of that is going to be end of quarter rebalancing, like winners, you're going to sell some winners, et cetera. Like, what do you think about that?
It's interesting because the thing that I think about with Nvidia and Bitcoin, a few years ago, Nvidia, its first big climb up was actually on Bitcoin because a lot of those chips were being used for mining. But then that focus went away and the focus went into AI, obviously. But I would say the correlation, the directional correlation is really pretty incredible on these two. They've been in lockstep with each other up until just recently. where Nvidia has continued to go sky high, but Bitcoin has reversed, maybe suggesting that as a risk-on, risk-off barometer that we're going to see a reconnection, Nvidia follow Bitcoin lower. That is what it looks like to me. So I think that investors are just taking profits in these big rallies. I mean, this year alone, at the beginning of the year, out of the pandemic, we did have Nvidia up 21. So right now, Nvidia out of the pandemic lows up 2,100%.
Right.
Bitcoin up 1,000%. I think we're going to see that gap narrow based on all of the past history.
All right, Abigail, thanks a lot. Really appreciate Abigail Doolittle joining us there on Bitcoin. What's also interesting, though, Romain, is that if you take a look at, say, Nvidia, you have Micron, though, still up, getting an upgrade. Then you have IBM also. It's sort of like IBM, Big Blue.
Yeah, I think everyone's trying to figure out, like, somebody else has got to benefit from this. And I guess people, I don't know, I feel like this is just kind of throwing, what is it, spaghetti at the wall or whatever and seeing what
Or a dart at a board.
Or a dart at a board or something. Remember those old days, like when we would have these bull market runs, and then, was it the Journal where they got like a chimp or something just to like throw like its feces or something at the Wall Street Journal and the stock? Those are the good old days.
Cool, cool. Okay, on that note, we're going to count you down to the closing bells with Ed Clissold, the Chief U.S. Strategist at Ned Davis Research. This is Bloomberg.
This is a pretty robust market environment that we've been through. Our approach has been remain diligent in rebalancing your portfolio. When these particular stocks are up a lot and the rest of the market is not, there is another 493 stocks in the S&P 500 that you should own a good portion of. Rebalance back into those, take the winnings, push into the ones that have been lagging behind, and know that that market naturally rebalances over time.
Jason Pride, the Chief of Investment Strategy over at Glenmede, helping to kick us off to the close just about an hour ago. Romain Bostic alongside Alex Steele. A mixed day here in the market with the S&P and NASDAQ deep in the red, the drag of Nvidia.
Yeah, hence like the rebalancing comment that Jason was talking about. But funnily enough, you have Nvidia getting hit, which is bringing down the tech index. But then like IBM is up 2%, right? Micron getting an upgrade also. Goldman Sachs having a $200 price target now on IBM. So it keeps making me think, is it a rotation underneath the surface or just a one-time rebalancing at the end of the quarter?
Yeah, I mean, I want to believe that this is a real rotation, but I also feel like we had this conversation maybe, 3 or 4 months ago. And then, of course, within like 2 weeks, everyone was right back in Nvidia, Microsoft, and everything else here. Let's pose that question to our next guest as we move closer to the closing bells. Just about 9 minutes to go. Ed Clissold joining us. He's the Chief U.S. Strategist over at Ned Davis Research. And Ed, maybe you can kind of give us some of that research. You're always good at kind of these historic narratives and historic parallels here. When you look at sort of the market breadth, or I guess maybe still lack of it, as we head towards the end of this quarter, is some of the price action that we've been seeing over the last few days and weeks, is that indicative of a real rotation, or is everyone just kind of getting their books in order, taking their profits, and then once July comes back around or whenever they're ready to invest, it's all back into Nvidia and big tech?
Well, yeah. Hey, Romain. Yeah, the story of this year has been one where these rotations have not lasted all that long. But if you take a step back a little bit further, go back to the start of this bull market that started in the fourth quarter of 2022, you have had a few of these that have lasted a little bit longer. And what it's done from a technical perspective is that it hasn't allowed the market to get too narrow. What a technical analyst would not like to see is these 5 to 7 stocks dominate for so long that, say, only 40% of stocks are above their 200-day moving averages. That's what happened in 2000. Instead, what we've seen is that most stocks have remained in long-term uptrends. For example, about 64% of stocks right now are above their 200-day moving averages. That's pretty healthy. So to get a period of rotation back and forth that lasts a few weeks is good enough to keep the long-term technicals healthy, and that's what we'd like to see for the bull market to continue.
What's the biggest risk right now that you see out for the rest of the year?
Yeah, so if I were to categorize the risk, I think that really more on the macro front, the Fed is trying to thread the needle. We think they are going to be able to do it. They're going to cut rates once this year, starting in December, and maybe a couple more times next year. But if inflation remains too sticky, they're not going to be able to do that. And on the other side of the coin, they have to make sure that the economy, which is still just still trying to get through some of those tertiary effects from COVID doesn't weaken too much. So I think that's top of our list. We have some other concerns, but I'd focus on the macro for the major concerns.
Bringing up the macro, Ed, Morgan Stanley, Mike Wilson was talking about the risk now, and the risk is like focusing on growth versus inflation, and that means you're going to still want high-quality large cap and not the risky small caps. I put that question to Jason Pride. He was like, nope, I like the small guys. What about you?
Yeah, so if you have a little bit of a longer-term view, I'd focus on the larger names, which is where we are. Again, you're going to get rotation here and there. I think the best opportunity for small caps is going to come when they actually start to cut rates. So if you look at what's happened historically, the Russell 2000 has outperformed the Russell 1000, but not until the Fed cuts. And going into it, it's still a large caps, especially what we call a slow cycle, when the Fed is cutting about every other meeting or even less often than that, because that means the economy is doing well. The Fed can afford to go slowly. So you get good economic growth, but some lower rates. And that tends to be great for small caps. So that's probably the best window for small cap outperformance, which we think is going to be a few more months down the road.
So then I guess what the underperformance looks like until then, particularly on Friday when we get the rebalancing and you have the guys like Supermicro going into the Russell 1000 and now the Russell 2000, which some are saying is going to make that gap with the S&P even wider. What kind of underperformance do we see until we get that catalyst you're talking about?
Yeah, I think it can be several percentage points, enough to where if you want to make a tactical allocation move, it's going to be worth it to go ahead and have that large cap balance. And I'd also remind you that it used to be fairly common. By the time we got to June, there were several stocks that were in the Russell 2000 and the S&P 500 because these small companies had grown so much and they graduated. It's just over the past 10, 15 years, that's been rare because companies stay private longer. They come public as a mid cap or a large cap, or they get gobbled up and by a large cap company before they even come public. And so that's the real challenge for small cap indices like the Russell 2000, to a lesser extent the S&P 600, is that there just aren't those great growth companies that are sitting in the small cap world to justify owning those indices over the large caps.
It gets to a question also, Ed, just about kind of the supply of new issuance and the lack thereof here. The idea here is that you've had, at least in terms of the total sort of number of investable names out there, that's kind of been stagnant for a few years. Is that now really starting to sort of assert itself? Is maybe that an explanation for why we do see a little bit more crowding in some of the big names?
Yeah, I really think it is. So if you look at, say, the Russell 2000, I'm sure a lot of people have seen the stats. About 40% of those companies are unprofitable. And the reason is that, say, 25 years ago, there were almost 9,000 publicly traded companies. So the smallest stock in the Russell 2000 was still in the top maybe third of all publicly traded companies. Now there's about 5,000 publicly traded companies, and a lot of them aren't even operating companies or SPACs or something like that. And so the bottom half of the Russell 2000 are things that aren't really institutionally investable companies. And that's part of the challenge here. So ironically, I think what may happen, this may take a few years to unfold, but if rates stay high, so if you're a company that's looking to go public, think, well, do I go with debt? Or do I go with equity? Right now, debt has been a cheaper cost of capital. It may become more attractive at higher rates to just go ahead and go public. And that may be when small caps become more attractive. So it's going to take a while for that to play out. You got the private equity space that is dominating that. So there's a little ways to go. But I think that the unattractiveness of going public is part of the small cap problem.
All right, I'm going to have to leave it there. Great stuff. Ed Clissold, Chief U.S. Strategist over at Ned Davis Research, helping us count down to those closing bells. Just about 2.5 minutes until we get there, Alex, with the S&P now and the NASDAQ hitting fresh session lows.
Yep, but the Dow is still outperforming on that level. Mary Daly was talking earlier. Did you see this one that the labor market is nearing an inflection point?
Yeah.
And if kind of things get worse, it could mean higher unemployment. And I wonder if it's the growth story now.
Yeah, it's kind of interesting, too, how this market kind of wants to divorce itself from the economics. But at some point, that's going to converge once again. And I'm not necessarily sure for the better. As we move closer to these closing bells, an eye on the markets, an eye on all assets, full coverage starting right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are about 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele to take you through the closing bell. And it's our global simulcast. It begins right now. Scarlet Fu joining us in the TV studio. Carol Massar lost in space along with Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms. Carol Massar here on this Monday afternoon.
Can we do like the debate on Thursday? Can we just shut off your mic? Can we do that?
Oh, Carol.
Oh,
she's coming in hot on this Monday afternoon.
What's wrong with her?
That was mean.
That was mean?
Yeah, he was saying lost in space because I think you said Danger Will Robinson earlier.
Oh, is that what you said?
From our
were you actually listening?
Romaine watches.
I used to listen to your show, but after today.
Romaine watches, he listens. Is that what you said, Danger Will Robinson?
I did. Wow, I'm really charmed that that was, okay. All right, I take it back. All right, let's talk a little bit about markets. Some outperformance, a little focus here. Banking stocks actually outperforming the broader trade here, up about 1.7%. You guys saw that story about folks in the know saying the Fed has shown some regulators maybe some changes to the bank capital overhaul. So maybe it could be a little bit more positive to banks. But banks have really been up, I think, most of the session here.
Look, I can't go any further without talking about
I'm trying to come back here. That
Nvidia.
Was hard.
It's just down 6.66%, down more than 12% over the last 3 days. Interestingly enough, not dragging down the entire index, although the NASDAQ kind of getting pummeled. But the S&P 500 only down 0.2%.
That may be the case right now, but you wonder what's really going to be the catalyst this week. I mean, we know PCE on Friday, but until then, it feels a little bit like we're just kind of drifting.
As we get the closing bells here in New York, some weird price action here on the day as you're seeing some of the transports, industrials, and cyclical names get a bid while everything else, I don't know, kind of is on the back foot. The Dow Jones Industrial Average higher by about 260 points, roughly 0.7%, right around that 39,400 mark. The S&P 500 is going to close in the red, only down about 0.3%. Obviously, a big drag today coming from Nvidia and a couple of the other big tech companies, including Amazon, Broadcom, and Microsoft. The Nasdaq also feeling the pain from those same names, lower by about 1% on the day. And the Russell 2000, a relatively decent bid here on the day, decent outperformance, up 0.4% here on the day.
All right, Romaine. So let's get to the S&P 500 a little bit more. Most names, surprisingly, actually gaining ground today. 353, 147 to the downside, 3 unchanged, even despite what I would call a meh trade here, Scarlett, on this Monday.
Yeah, I'm looking at the sector performances, and 9 out of 11 groups are in the green. Now, it doesn't look that way on this IMAP because tech, which is the biggest sector in the S&P 500, is down by more than 2% thanks to weakness in Supermicro, Computer, and Nvidia. On the flip side, the biggest gainers, energy. You have all 22 energy names in the S&P 500 gaining as oil prices rebound. Utilities and consumer staples also doing at least better than 1%.
All right, Scarlett, let's get to some of the individual gainers. Kind of a mixed bag for me. ALNY, Alnylam Pharmaceuticals, really an outperformer in today's session, up about 34%. This is after one of its drugs succeeded in treating a progressive and deadly form of heart disease, potentially opening up a new avenue for the company's top-selling products. So this was certainly a big gainer in today's session. Cocoa prices easing, slumping the lowest in about a month. Some favorable weather in West Africa boosting the supply outlook amid thin trading. So you had names like Hershey up about 2.9% in today's session. You had Mondelez up about 2.9%. So some outperformance in those names. And here's another one we don't necessarily talk a lot about, RXO. This one was up about 23% in today's session. The trucking company agreed to buy UPS's asset-light freight brokerage business, Coyote Logistics, for more than $1 billion in a deal that adds scale, according to analysts. So that was an outperformer in today's session.
Okay, you got the gainers. I got the decliners. I do want to start with shares of Nvidia. They fell 6.7%, closing with the biggest drop in 2 months, down for a third day in a row. Over that 3-day period, down close to 13%. So officially in correction. Lost about $430 billion in market cap over the last 3 days. It's no longer in the $3 trillion club when it comes to market cap. We should note it's up nearly 140% so far this year. So zooming out, the stock has still had just an incredible performance. The last 3 days have been tough for shareholders, if they got in, especially if they got in just last week. ResMed shares falling 11.5% today. On the percentage basis, the worst performer in the S&P 500. makers of devices that treat sleep apnea, such as ResMed, tumbled today. It followed additional clinical data from Eli Lilly that showed its weight loss drug reduced the severity of sleep apnea. So we saw shares of companies that make devices to treat sleep apnea fall today on that news. Also watching shares of Coinbase down 6% as crypto-linked companies fell today. Bitcoin did extend losses over cooling demand for Bitcoin. Finally, I do want to talk about ADRs of Airbus, checking in on those, down more than 6% today. This after the company cut its earnings and aircraft delivery goals for the year. Supply chain issues, believe it or not, continuing to deprive the company of components. It's a setback for Airbus at a time when demand for its jets are at a record. So still having supply chain issues when it comes to getting those critical parts for aircraft.
All right, guys, looking at the bond market, I mean, there's really nothing to see here. It's back-end loaded, a little bit of buying coming down, yields a little lower into PCE. But I just want to point out, some are looking at 4.186 on the 10-year, that being a technical level. And it's not that we're that far from that level. So kind of watch that as we get into the heavy eco data on Friday.
Well, speaking of eco data, maybe a potential read on economic conditions. Pool Corp, we don't talk about it a lot here, but it is the dominant seller of pools, and it just revised its guidance for the quarter lower by a significant amount. The company saying that it now sees new pool units for the full year down 15 to 20%, and says that it's seeing remodeling activity overall in homes down about 15% on this year. That compares to a previous estimate of flat to down 10%. The net effect of that is that the EPS range, the guidance that it's giving for the full year, $11 to $11.44 a share. Its previous guidance was $13 roughly to $14 a share here. So again, less a concern maybe about Pool Corp itself and maybe a read on discretionary spending, at least on some of those big ticket items. We should point out the shares are actually halted right now, which is why they're unchanged.
Yeah, just looking at the release, the most recent pool permit data suggests persistently weak demand for new pool construction. Peak selling season almost complete. We now believe that new pool construction activity could be down, as you said, 15 to 20% for the year. Remodel activity down as much as 15%. So you do wonder whether, I don't know, is it just that everybody's done it or just people pulling back in general, at least for those who are thinking about...
Have you seen the cost of a pool?
It's not inexpensive.
Very well said. What's interesting here is in this release, they say that more than 60% of our business comes from recurring revenue and is generally not impacted by macroeconomic conditions. So these are customers who normally would spend a lot and not spending as much.
Yeah, well, it's all like the accessories and stuff. I remember my uncle got a pool, and like all he did was complain about the cost to maintain it.
It's
best
the
thing to
chlorine,
have.
it's all the things, yeah.
The best thing to have is a friend with a pool.
I have that.
Not an actual
It's
pool.
awesome.
Everybody knows that. And you know what else, Carol? It's good to have a friend with a boat.
Yes.
Which I've never been invited.
No idea what you're talking about.
Yeah, one day that yacht of yours, to have a Bloomberg markets to close.
So let's talk about something that is not going on anymore. It turns out, do you get your shoe shined?
Well, okay. Go ahead.
No, do you any of you guys?
I do. Yeah, you know I do. So go ahead.
I know you do. You're pretty dapper. So what's interesting, though, is it's really kind of been a staple of New York for decades, years, right? I mean, people, just not even just Wall Streeters, but everybody, right? You go to a stand, you sit, you get your shoes. I've done it. It's kind of fun. It's kind of neat. But it turns out, as the world has gotten much more casual and they're wearing things like sneakers, unfortunately, these guys, they don't have a lot of business
anymore. It's Tim's fault. Tim, because you know that guy wears sneakers in the office.
I wear sneakers
like
nonstop.
Tim.
Hey, it's not just me. Jamie Dimon is now wearing sneakers. So
he wears a pair of black Common projects. I've never heard of Common projects.
I haven't either, but I gotta look them up after this.
It's like Golden Goose, $400. They're not distressed.
Speaking of distress,
expensive.
The whole thing with the shoe shiners is that they're now trying to clean sneakers, so you can go to them and then they'll make your sneakers look good, which is tough if you're wearing Golden Goose.
I was just going to say, yeah.
Yeah. Well, I'll just give you an anecdote. I do get my shoes shined around the corner from here, and the woman who used to do it, she's no longer there.
Oh.
She's not working. I don't think she got as much business once they reopened after the pandemic. So,
yeah.
So unfortunately, she moved on. So sorry to end on that sad note there.
Yeah, that's not good. But the idea that you got to sort of pivot and that Wall Street is definitely changing is a big part of that. Okay, let's go to something else that's kind of fun. And that apparently is that the so-called Ozempic revolution has wiped off, billions of food and drink companies. That's what they're calling it. It's an Ozempic revolution with a capital O and a capital R. So apparently that they're boosting sales of yogurt.
Yogurt.
This is a new thing. That maybe with yogurt, that's
Does that
a way.
help you lose weight?
I think that maybe you go from chips to yogurt.
It's high protein, and it's not too filling because, Ozempic obviously makes you not want to eat as much. It reduces your craving, but you get the protein. So that way you get the protein, but in a smaller package. And so all the yogurt companies are like, we're totally seeing a lot of demand. We're delivering a lot more varieties.
Remember a few months ago when everybody was concerned about the, the packaged food companies just struggling as a result of Ozempic? Well, we all knew that they would actually just change what they were selling and get people to buy what they were, buying before or what they're buying when they're taking Ozempic.
It's not just yogurt, too. I was, there's going to be a debut in a couple weeks. I had down at General Mills, I got to interview their CFO for a special project, and they were talking a lot about, they took me through their test kitchen, all these new products they're trying to come up with to kind of address, I guess, what Alex was talking about there, which is, I guess, when you're on Ozempic, you need a certain different type of protein or different level
and also
or
it doesn't fill you as much.
So, so all these food companies are working on trying to head that off at the pass.
All right, so that means, Tim, no more sandwiches.
No more sandwiches? But cereal and yogurt, that's fine.
PBJs. Tim's a big PBJ guy.
Dairy.
In the 4 o'clock hour, they come out.
Does he take the crust off, too?
No.
No, but it's a big sandwich. All right,
Whole
guys,
thing.
that is a wrap. Our cross-platform radio, TV,
Rocket fuel,
YouTube,
Tim.
Bloomberg Originals. We will see you again, same time, same place tomorrow.
All right, stick with us. A lot more coverage coming up here on Bloomberg Television. On the close, a closer look at summer travel and airfares, which are still sky high. A discussion after the break. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how markets ended here on the first trading day of the week. A down day for the S&P and the NASDAQ, dragged down by big tech. Maybe we are starting to see a bit of a rotation away from Nvidia and some of those big tech names into something else. We saw the Dow Jones Industrial Average, Dow Transports, and even the Russell 2000 get a pretty decent bid here on the day. But risk sentiment has been hit in a couple key areas here. You see that in the drop in Bitcoin below 59,000, and you see that in the Philadelphia Semiconductor Index down 3% on the day. And it wasn't just Nvidia, was it, Scarlett?
Well, Nvidia was a big part of it, right? Nvidia down for a third straight day. It has entered a correction, which means it's down 10% from its recent high. It lost more than $400 billion in market cap over this 3-day slide, pushing its value below $3 trillion. So in terms of market cap, it's now below Microsoft and it's below Apple as well. Could it be AI fatigue? Yeah, maybe. Is it because the rally went too far too fast? Yeah, maybe as well. Nevertheless, stock off by 6.7%. Chipotle also down for a third day, although its losses have moderated here a bit. Last week, it closed at a record high, and analysts at Baird say that news that the U.S. suspended some new avocado shipments from Mexico may have weighed on the stock, but the analysts there say that they're not concerned about this particular issue. And Alnylam Pharmaceutical is gaining 35% today. It soared after its drug succeeded in treating a rare and progressive deadly form of heart disease, potentially opening up a new avenue for the company's top-selling product. Basically, analysts say the test results were a best-case scenario for the company. Let's move on to our top story this hour. Summer is in full swing, which means packing your bags and getting ready to travel. AAA projects a record-breaking 70.9 million people will head out of town for the 4th of July holiday. That is an increase of more than 8.5% over 2019, which was, of course, before COVID. Now, in the skies, strong global demand coupled with a shortage of new aircraft will likely keep airfares lofty. We'll be speaking to the managing editor of The Points Guy about strategies to redeem your loyalty points, and we'll also preview quarterly earnings for cruise ship operator Carnival.
All right, but let's start in the air space here, particularly airfares. And we're actually going to start overseas because Asia's biggest low-cost air carrier actually gave a warning saying that there's no end in sight for some of those high ticket prices. However, the Air Asia CEO adds that there could be a little reprieve next year. Thomas Black joining us right now from Bloomberg Opinion is down there in our Dallas office to explain this. Why aren't we getting the reprieve right now, Thomas? I want it now.
You might have to wait a while until Boeing and Airbus can crank out planes like they should be able to. They're having supply chain troubles, and then of course Boeing is having particularly big troubles, especially after it had that accident in January where a door plug blew out, where that aircraft was in the air. So they are not producing as many aircraft as they should be. In fact, Airbus just cut its forecast for aircraft production this year to 770 airplanes from 800. So it's going in the wrong direction.
Yeah, and of course, Boeing and Airbus basically split up all the aircraft manufacturing in the world for all intents and purposes. The thing is, we know that airlines are now leasing more older planes, but that also has a cost to it, which I guess to some extent consumers end up paying, right?
That's right. You have to repair them more often, and there's a shortage of mechanics. It also puts the aircraft on the ground, which is not a situation that airlines like. They like to have their airplanes flying. And we're also seeing more flyers. We finally are surpassing the 2019 levels. The International Air Transport Association is predicting we're going to have 5 billion passengers this year. That breaks a record, and it's higher than the about 4.5 billion that were in 2019. So we're having two things happening at once. We're increased demand and less supply. So that's not a good thing for airfares.
All right, Thomas Black of Bloomberg Opinion here as we focus here right now in on what's going on in the travel sector, particularly when it comes to airfares. Clint Henderson joining us right now. He's managing editor of The Points Guy. And Clint, I mean, there is going to be some reprieve out there. I mean, The Points Guy, your website, is telling me that maybe I should be looking for cheaper airfares?
It's remarkable. Yeah. So we're seeing normalization of airfares, especially in the United States. Now, internationally, that may be a little different.
Normalization, does that mean cheaper?
That means cheaper
all right.
compared to what we saw in 2022, 2023, when demand exploded. There was not enough aircraft. There was not enough seats. The airlines have normalized the number of seats. They've added flights. We're now up to a point where we're seeing deals, even last minute, for peak summer travel.
Wow.
So Paris. But you have to remember, they've added a lot of seats to Europe specifically. And then we're also seeing, like, the Paris Olympics. I think they overshot the expectations around what the demand would be like.
So am I going to see, because I traveled a lot during the spring, and I noticed every flight I was on was jam-packed.
Yeah.
And if you tried to change a flight, forget it. You weren't getting home. So is that eased up a little bit? So next time I have some travel coming up this summer, when I get on those planes, do I have a chance that nobody's going to be sitting next to me in that middle seat or something?
No. Planes are totally full. And I will say, like, we have seen prices reduce a little bit, but demand has not reduced at all. So the demand is at peak levels. And remember, all the business travelers are now back in the air. So we've seen almost a complete recovery in business travel, which we hadn't had before. So it's a really interesting combination of factors right now. But prices are down to where they were in 2019, which is remarkable. And you can find some last minute deals even to Europe.
Yeah, well, and the interesting thing, of course, is with business travel, the return of it, it's also been normalized where people can take vacations around their business travel. Leisure, so that just kind of adds to it as well. You mentioned Paris. We know the Olympics are coming up, so that's a big destination. But I think about how TV has overtaken our cultural lives, and, you know, the White Lotus, the White Orchid or White Lotus?
White Lotus.
White Lotus, thank you. And, of course, Game of Thrones taking place in Croatia. Like, Sicily and Croatia have become, like, must-see destinations, and they've become overrun with tourists.
Absolutely. This is the set jetting trend that you hear about so much. And now we got White Lotus Part 3 going to Thailand. So you're seeing this trend more and more and more. But go to the second tier cities. Go to places that maybe haven't been completely discovered. And remember, the US dollar is very, very strong right now. So if you've ever thought about traveling internationally, now is the time to do it.
The other thing, of course, that's come up, I noticed that San Francisco has been branding itself as a really cool place to be temperature-wise because everyone's trying to escape really hot destinations.
Coolcations.
Coolcations, yes. Wow. Exactly. That's a thing now.
Yes, it really is. People are going to places like Estonia, places where it's not going to be baking hot like it will be in Southern Europe. San Francisco is a great city in the summer. Also, San Francisco, because it had so much negative media attention, prices are remarkably low for even five-star hotels for $200 a night.
Yeah, didn't our executive producer go to Estonia or Albania or somewhere? And I was like,
really?
Yeah. I was like, I don't know.
Albania's hot right now.
Yeah, well, he's the ultimate jet setter. He's always, I don't know, where is he now? Like on the Amalfi Coast or something? Who knows?
Yeah.
Good for him.
I can't keep up. Yeah, I know. I want his life. I'm curious, though, about just planning trips, too, because you say go to the second tier. Because, you know, a lot of us are pretty busy.
Yeah.
And particularly when you're trying to plan for your whole family. Yeah. And everyone's got a different opinion about where to go.
Right.
It's a pain in the butt, by the way. But now people are telling me I can use these, you know, chatbots and these sort of AI tools that maybe will streamline the process. Are you seeing that as an effective option?
We have really tried to use AI for trip planning. It's not there yet. It's just not ready for prime time when it comes to that stuff. You're going to more likely see it on the back end where like third-party booking sites are using it more effectively. But for the average consumer, it's just not ready yet. We tested it to try to, it didn't work out too well for us, but it is coming. Don't get me wrong, it is coming eventually.
Well, what about, though, the future when we talk about just planning trips. And now, I mean, most of us are just kind of left to our own devices. We just have to go do our internet searches, or we talk to friends or coworkers about where they go. Is it going to be maybe something a little more streamlined for them in the future?
At the very high end, travel agents are making a huge comeback. So
I've heard this,
for the very wealthy, they're going to curate a perfect trip for you. For the rest of us, Google does a great job. One of my favorite tools is Google Explorer. You literally type in your home airport. It tells you the cheapest places you can go, even last minute. It'll give you like airfare to Bermuda this weekend is $300 or whatever. So you can really find some good deals that way.
That's good as long as you're willing to pay for it. What if you want to actually redeem the points that you have? You guys are the points guy. In terms of the valuation of those points, are there some that I have to use up faster than others because they've been devalued so quickly?
Some points do expire, so you got to be really careful with that. But more and more, the big programs are not expiring their points ever. So Delta, American, your points are not going to expire. You don't need to worry about it. But you are going to be able to stretch your value with a credit card currency through Chase or American Express. If you transfer it to an international partner like Air France, Flying Blue, sometimes you can get a business class seat to Paris for 50,000 points.
Okay, but that's extra work for me as opposed to calling up the Chase Travel Center where I can just book my flight directly. Except I've heard that those flights are priced higher than if you were to just go to the airline's website.
They're usually not priced higher, but you're going to get better value if you transfer those points to an airline instead of redeeming through Chase.
Okay. All right. Well, I want to squeeze in one other question here, though, too, because I saw something in your notes on Points Guide that people are actually looking at train travel a little bit more. I guess more kind of experiential train travel, not just getting on the MTA or anything.
Super high end.
That's experiential
trains.
also in a different way.
In the wrong way.
Think the Orient Express, things like that. But for most of us normal people, Amtrak is a great way to see the country.
Well, I second that. As somebody when I was a kid, I used to love riding on Amtrak just to see things. And one of the best trips we actually took, we were in Switzerland. This was a few years ago before the pandemic, and we took one of those long train rides all the way through, the Alps. And
that sounds great.
Down through Zermatt, and it was just a phenomenal.
Trains in any other part of the world is fantastic, just not in the United States.
Well, I mean, God.
But even here, we've got the Empire Builder in Montana that goes all the way to Seattle. Amazing journey through Glacier National Park. So put it on your bucket list.
Oh, okay. I hadn't thought about that.
It is Amtrak, though. Just keep the expectations within reason.
Right. So when you book and you go online, you're going to still have to deal with Amtrak's infrastructure.
Yes.
Clint Henderson, thank you so much, managing editor of The Points Guy. I'm trying to think the last time I had a train ride that was great, and it was in Japan on the bullet train.
Oh, amazing.
Right?
And it is so funny. I mean, you mentioned kind of when you go overseas. I mean, anyone who knows, you're in the U.S., you take Amtrak's fine, but then you go to Europe and you get on their trains, and you're like, why can't we? Why can't we have this?
I know.
Why can't we have nice things, Scarlett?
We don't like to pay for nice things. That's the thing. All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Sean Evans. He is the host of the popular YouTube show called Hot Ones. And the future of his show, uncertain, because BuzzFeed is struggling to sell the company that owns the show. UBS is running a formal sales process. It initially asked for more than $70 million. And after months of talks, it has yet to find a buyer.
Yeah, I'm kind of surprised. I mean, this was obviously a hit for a while. I mean, for some of us during the pandemic, this was kind of must-see TV. It seemed like he built a big brand. And I heard a podcast once, they really kind of talked about the economics of how he built the business, how they really kept the costs lean up in front. That's why they just kind of in that dark room with just a black background. And he got all these celebrities to come on. It was totally disarming them. It was great.
Yeah, it does generate $30 million in annual revenue and is profitable.
Yeah.
But he does not have a long-term contract with the company. So they're looking to maybe sew that up.
All right. Well, another person I'm keeping an eye on is David Tepper, the owner of the Carolina Panthers, and he's pitching a $1.3 billion stadium upgrade with city council members expected to vote on that proposal today. That's just, of course, we're talking about Charlotte, North Carolina, and of course, a lot of folks, anytime these billionaire owners come asking for billions in tax dollars to do something for their privately held businesses, sometimes it becomes an issue.
Yeah, well, voters are increasingly unwilling to subsidize that and pay up for it because they're like, hold on, you promised all this stuff and it doesn't really come to fruition like that. And we've seen voters in Missouri reject a measure to upgrade the facilities for the Royals and the Kansas City Chiefs. In Illinois, the governor has called the Bears plan to build a new stadium a non-starter.
Yeah, well, he called their bluff on that. But it gets to the question, too, where are these teams going to go? Because that's always a threat. Is if you don't give it to us, we'll just go to the neighboring city or the neighboring state.
The Bears aren't going anywhere.
But there's only so many places you can go. And leave the Bears alone, please. They've suffered enough.
All right, the third person I'm watching is Travis Kelce. Speaking of the Kansas City Chiefs.
I never heard of him.
Yeah, well, he's the tight end of the Chiefs, of the Super Bowl winning Chiefs. Yeah. He joined his girlfriend Taylor Swift on stage last night in London.
So,
he was on there during a transition between songs. He came on stage in a top hat and tails to help her with her costume change. He carried her across the stage. He helped her touch up her makeup. He knew his place.
So I just saw like a small clip of this that was circulating online, and I was totally confused. Why is he in a top hat and tails?
He's supporting her.
Is that how you do it? Is Taylor Swift demand all her boyfriends just wear top hats and tails
I think
and carry her around?
I think he asked whether he could be part of this.
I need some yogurt, some high-protein yogurt out of the fridge.
He wanted to be part of the tour, part of the experience.
She's like Ariana Grande.
No. Appetite for a Vegas residency reaching new highs, reminiscent of the 1950s, 60s, and 70s that pioneered that lucrative business. Last year, Sin City welcomed more than 40 million visitors and sold more than 3 million tickets for concerts and live events, making it the perfect market for artists to profit from the highest ticket prices in the U.S. Joining us now with more is Bloomberg's Ashley Carman, who covers the music industry. And Ashley, I know that you look at things from the point of view of Spotify, but when you look at live concert events, it used to be that a Las Vegas residency was something that like maybe the has-beens did when they want to settle down and not really travel as much. They could settle down in Las Vegas and have people come see them. But it's kind of turned into something more than that.
Yeah, totally. I think Celine Dion kind of changed the game with this. Obviously, she established kind of the residency there in the sense of a modern, immensely talented artist setting up shop. And now you see all sorts of artists. Christina Aguilera's doing a residency there. Usher just had a really high-profile residency. Adele. I mean, these are huge names that people currently very much want to see. And it is a little bit easier on the artists.
It's easier on the artists. It's easier on the fans as well. I mean, I know obviously the fans then have to sort of travel to that location. So if you don't live in Las Vegas or in the western part of the country, it's a little bit more of a haul for you. But to mention, the Scarlett's point here, I mean, I was just in Vegas early this year and I was surprised at how big some of the names were that were there. It's still relevant artists, not the older ones.
Yeah, and I think, Vegas is just such a destination. You're doing bachelor trips, bachelorette trips, you're doing family vacations, you're doing all sorts of different reasons to go there. And so I think when you have this wide range of artists, it kind of makes it even more of a destination, which Vegas already is. You're going to party, you're going to go to concerts. Like, it's just fun.
Talk a little bit about the facilities, because you have really intimate venues, like where Christina Aguilera is performing. And then you have the Sphere, which was built by James Dolan, the owner of MSG, which is this massive dome. I have not gone inside of it.
When I was in Vegas earlier, my hotel room overlooked the Sphere.
And you couldn't sleep, right? Because the lights are so bright.
I was like, what was that Seinfeld episode when Kramer was the chicken, Kenny Rogers chicken? Sorry, I stepped in your question.
No. So,
did you have a question?
I did, I did. Talk a little bit about the facilities and how that changes the game here.
Yeah, so to your point, you do have a variety of options. You have, of course, like the mega theaters where you can really, do amazing set design. This is part of the reason people want to do a Vegas residency, is you don't have to haul your stuff and your staff around the country or the world and set up night after night. Instead, you can really build an elaborate stage setting. That's a cool showstopper, and it's there every single day. The Sphere, though, has really obviously become, in itself, a talking point and destination.
Do the economics, though, work for the artists in that fashion? I remember when I was there, Usher was performing, and I was like, let me look at tickets. And I think literally the cheapest ticket was like, $700 or $800 to sit like in the back row behind a pole. And I do wonder that if they went on tour into bigger, less intimate venues, they could not only get more folks in there, but in theory have maybe a little bit more spectrum on pricing that would also broaden it out. Or does that not matter to them?
Well, the thing with the touring economics is after the pandemic, inflation.
Yeah.
And staffing became more expensive. There was a shortage of tour buses. People were flying private just to try to get even small bands around the country. I mean, this became a very expensive endeavor.
Yeah.
So that is where they can save on those costs. And then to your point, again, it's sort of this destination trip, especially if they're making really amazing visuals for the show. So they have an opportunity to actually make some significant money there.
Do you have any concerts you're going to this year that you're looking forward to, or no?
I really want to get tickets to Mark Anthony's show. He's doing a show at Barclays.
Okay, Barclays.
So she's not traveling to Vegas, but
I'm not going to Vegas.
Taking the 4 train.
All right, Ashley Carman, who covers the music industry for us here at Bloomberg. What about you, Sarah? Are you a concert
I'm going
person?
to some 80s concert, somewhere downtown Manhattan where there's a curfew at 11 p.m. So it's going to definitely end.
So this is like for older people.
Yeah, I mean, I think the Thompson twins are playing. So
the Thompson.
Yeah.
Twins. Oh, wow, that's a blast from the past.
It is.
I got to check that out. All right, from concerts to cruises, Carnival Cruise actually set to report earnings tomorrow before the bell, and Wall Street right now is really focused on its ability to sustain bookings and pricing. Jody Lurie joining us right now, covers credit over at Bloomberg Intelligence, and has been all over the Carnival Cruise Line story for a while here. I don't know, Jody. Everyone is always telling me these companies, they got too much of this. They're struggling this. I don't know. It's a cruise ship. Everyone, people who love cruises, Jody, as you know, are always going to go on cruise. Literally, they could go bankrupt, and they will find enough money in their couch cushions to get on a cruise. What's ailing Carnival, if anything?
I think you make a good point, Romaine. So people definitely want to go on cruises and they want to spend, and the cruisers are going to cruise. It's that new to cruise that's the question. And we are seeing that people are going on cruises at a higher rate, and people who haven't cruised historically are cruising. But they're being more selective in how they cruise. That said, what the companies are doing that's a little bit different is they're encouraging people to spend in advance of their cruise for the onboard spending. And what Carnival has described to us in the past is that creates this sort of free new wallet for them once they set foot on the ship itself. So they spend on these excursions and drink packages before they get on the ship. And then when they're on the ship, they say, life is too short, let's spend some more. So that's actually pretty profitable for them.
That's good. And so in terms of like the business, when we start to talk about what we're going to see in the earnings here, what sort of helped them so far? Is that sustainable? Because I seem to remember the last earnings report, there was some concern that the big sort of post-pandemic rush for people to get back on those cruise ships, that might have leveled off a bit.
That post-pandemic rush is potentially waning, but we haven't actually seen that. We were convinced that 2024 was going to be a much more moderate year than 2023. And in fact, we've seen much more momentum. Bookings rates are at some of the highest levels. And what I think I'm going to be most interested to see tomorrow is where bookings actually land once we have the full wave data in. So wave season goes traditionally the first quarter up through about mid-April sometimes, depending on who you ask. But usually it's that January, February, March booking, and Carnival straddles its earnings between the two quarters. So it will be interesting to see what the bookings levels are once we get to this second quarter that Carnival reports tomorrow. And that's going to be indicative of cash flows going into next year.
Thank you for breaking that down for us. So in terms of what Carnival says, how much of that is applicable to the rest of the cruise line industry? I think about the big players here, Carnival, Royal Caribbean, Norwegian Cruise Line Holdings, and now Viking in there as well. How do you differentiate between these companies? Which one is the most financially healthy right now?
Most financially healthy. So Royal Caribbean is, as we've been saying, about a few quarters ahead of Carnival in terms of deleveraging. Both companies have their sights on investment grade ratings. They would like to get there. Royal Caribbean by 2025, potentially could get there earlier. Carnival hoping to get there by 2026. Norwegian is taking a different strategy. They're deleveraging by way of growing EBITDA, less so than repaying debt. They're refinancing debt, they're pushing out debt, but they're not aggressively repaying debt the same way that we're seeing that Royal Caribbean and Carnival are. They want to get their balance sheets back to pre-pandemic levels, at least Royal Caribbean and Carnival do.
Okay. Is there going to be any consolidation in this industry, or that's all been said and done and we're pretty much where we are now?
There could always be consolidation, Scarlett. I mean, if you look at the industry, we've seen a long history of consolidation. We've also seen that the companies are being more selective in what brands to have in there. Royal Caribbean picked off Azamara a few years ago. Carnival is closing out one of its smaller brands based in Australia because it's not seeing the benefit there. Mm-hmm. And I do think that there is an argument to be had to have fewer brands. If you look at our survey from the most recent quarter, we asked people specifically what brands are their favorite, but we asked by way of a list, as compared to people just free answering what brands they liked. And that changed the dynamic. Royal Caribbean ranked #1, whereas Carnival ranked #2. When we had people do freeform, they listed all the different Carnival brands that we had to aggregate. So I think there is sort of justification to having multiple brands, but there's also justification to having one dominant flagship brand.
Got it. Jody, really appreciate your joining us. Thank you so much. Jody Lurie of Bloomberg Intelligence. Romain, I was reading about how Four Seasons and Ritz-Carlton now have their own yachts.
Yeah.
So people are willing to pay tens of thousands of dollars to have that experience, which is separate from the cruise ship experience, which is massive, right?
Yeah.
This is very, very intimate one-on-one attention from the staff.
I'm a little bit more into that because I've never been on one of those big, gigantic cruises.
That tracks with your branding.
But that always scared me. Why do I want to get on, and be stuck with, thousands of people?
You don't want the T-shirts?
I don't, actually. And, but I feel like those smaller cruises, obviously they're more expensive. That's the catch. But I feel like, at least for me, that would be a better experience.
And they're more nimble.
Yeah.
They can go into different ports and go into different cities as well, right? They're not limited to just ports that can handle that kind of big ship.
Yeah. Well, I've had one of those ships bookmarked for a while because one of my big bucket list trips is to go around Tierra del Fuego, and you kind of have to do that on a ship of some kind.
All right. So you're going to do this?
Booked. Yeah. Well, it's expensive and it's a long trip too. You need a couple weeks to do it. So.
Oh yeah.
And I don't know. They don't give us. They give us what, 2 days off?
You're not allowed to take off that much time, Romain.
It's awful.
Let's take a look at how markets closed on the day here. The S&P 500 drifting lower. We've got a big data point coming up at the end of the week.
Wow.
Yeah, core PCE, of course, the Fed's favored measure of inflation. In the meantime, the yen has actually strengthened for a change. Up by 0.1%, not a whole lot, but Bitcoin extends its decline. You could see that it's now below 60,000.
I'm fascinated by this Bitcoin story, by the way, because it doesn't seem to be any fundamentals driving this down. It's just all kind of technicals.
Were there any fundamentals driving it up?
It depends on who you ask, but no, is the short answer to the question. When we return, we're going to take a look back in history and the birth of FedEx. The question before we go to break: how many packages did FedEx deliver on its inaugural flight back in 1973? The answer when we come back. This is Bloomberg. 53. That's what Scarlett's picking.
That's my guess.
This is Bloomberg. All right, let's look back in history. This day, June 24th, 1971, Fred Smith, he filed paperwork in Delaware for the formation of an air freight company called Federal Express. Now, the idea had been born about a decade earlier when Smith, who was an amateur charter pilot at the time, noticed that he was frequently getting flight bookings to ferry spare parts for computer companies like IBM. So he decided to write a paper for his economics class at Yale, making the case for an overnight air delivery service. Now, Smith would later take about $4 million inherited from his father and $80 million he raised from venture capitalists to pursue that idea. While Federal Express incorporated on this day in 1971, it would take almost 2 years before it began delivering its first packages. And it was a lackluster launch. From Memphis, Tennessee on March 12, 1973, a launch that carried just 7 packages on the night's first run. Disappointed, Smith relaunched the service a month later with different routes, this time handling 186 packages on the first day, not nearly enough to have a sustainable business. But he would soldier on, and his fortunes would change quickly. First, more companies realized that Federal Express was faster than the Postal Service. Second, a 1977 law deregulated domestic air cargo transportation. And third, the evolution of just-in-time inventory business models sparked a boom in world trade. Volumes rising from $500 billion a year in the early 1970s to $3 trillion in world trade by the late 1980s. And Federal Express rode those waves all the way to become the first company to reach $1 billion in revenue within 10 years without an acquisition. By 1994, Federal Express shortened its name to FedEx, sitting atop the hill of all global shippers, and today ships more than 16 million packages each day. FedEx, though, like many pioneering disruptors, now finds itself disrupted a bit as its businesses shift away from air freight to more ground transportation services. The new CEO, Raj Subramaniam, he entered the picture just about 2 years ago, and tomorrow he is expected to finally update investors on the process of restructuring the company's air and ground delivery units into one. This is part of a sweeping plan that was intended to update the company for changing times and hopefully to ensure that FedEx keeps flying for another 50-plus years. Scarlett?
And of course, we will be covering those earnings for you tomorrow in the close. We'll be covering the earnings here first. And of course, the focus on cost cutting will hopefully allow the company to then move on to revenue growth and driving revenue growth. In the meantime, let us switch now to politics and focus on some of the key races in tomorrow's primaries. And one of the most watched will be in New York, a suburb of New York, where Congressman Jamal Bowman is in danger of being rejected by fellow Democrats. Joining us from Washington is Bloomberg Balance of Power co-anchor Kailey Leinz. So, Kailey, I live in Westchester County, New York, and when I take the train, there are people up and down the platform handing out pamphlets and placards to try to get people to vote for this primary, which generally doesn't elicit a lot of drama or anything. But this time around, it's pretty neck and neck.
Yeah, and a lot of money is being thrown at this race, Scarlett. It's New York's 16th congressional district. And as you mentioned, this could be the first time that an incumbent Democrat goes down in a primary cycle. That incumbent is Jamal Bowman, who is a member of the squad, essentially means that he is a progressive backed by the likes of Congresswoman Alexandria Ocasio-Cortez. And he's up against a challenger in George Latimer, who is actually backed by establishment politicians, including Hillary Clinton. What this race ultimately could really come down to is Israel policy. Bowman, being a progressive, has been highly critical of Israel and its ongoing war with Hamas. He has accused Israel of committing genocide in Gaza. He's encouraged the Biden administration to cut off all funding to Israel, whereas Latimer, his challenger, is a much more pro-Israel Democrat. And according to polling from Emerson, voters in this district more align with Latimer on the Israel issue than Bowman. Only 29% of voters are in line with Bowman's position on this. And that's a big reason why it does look like Bowman is going to go down in the primary tomorrow. The latest polling from Emerson showed him down 17 points. Latimer polling at 48% relative to Bowman's 31%. And a lot of that could come down with the money being spent against Bowman. Yeah. AIPAC, which of course is a pro-Jewish super PAC, has spent $15 million on this primary race.
I am curious about this, whether this becomes a litmus test for other Democratic races, including the presidential race, because we know there's been a bit of a split in the Democratic Party as to how to articulate, I guess, their general policy on what's been going on in Israel.
Yeah, absolutely. This is an issue that has split the Democratic Party very publicly, Romaine, and this is something that's dogging President Biden as he campaigns for re-election as well. What's going to be interesting is to consider the age demographics in each of these districts, and ultimately considering how that factors into November. Youth voters are far more likely to align themselves with candidates who are more critical of Israel. That is definitely the case in the polling we have seen in this race. Bowman polls much better with voters under 40, whereas Latimer is more attractive to voters over 40. It just happens that in this district, the Democrats who are likely to show out in a primary vote do tend to skew older, which is something that could work against Bowman. But it's factoring in that youth vote and whether or not they're likely to show up and turn out in November that ultimately could decide the fates of Democratic candidates who might find themselves viewed critically by a lot of those youth voters who are more pro-Palestinian.
All right. Well, a key primary race here in the New York area, of course, a heavily Democratic district. So the primary effectively determines the general election for the most part. Kailey Leinz will have full coverage of this alongside Joe Matthew on Balance of Power, which starts at the top of the hour. But before you go anywhere here, stick around. We're going to set you up for some of the big things to watch over the next 24 hours right here on The Close on Bloomberg. All right, the hottest ticket in town isn't the Eras Tour. It is Bloomberg Invest. It kicks off right here in New York tomorrow, where leaders in asset management, banking, private markets are all gathering down in the heart of New York's financial district. Sonali Basak joining us right now for a preview of what to expect. Some big names. Was it Cliff Asness, Robin Grew, Todd Bowley? I know I'm forgetting a bunch of others. Ray McGuire. Just start off. Who's going to be your favorite?
Oh, well, we start off tomorrow morning. It's funny. We're still doing all the last-minute preps. Yeah. We have Todd Bowley first thing tomorrow morning. Mm-hmm. And do you ask him about his next big investment in sports, or do you ask him about which credit firm he's going to buy next after the Hayfin deal fell apart so far? So a lot of these... Sports, right? I know. Honestly, on all fairness, too, the next day after that, we have Josh Harris as well. Mark Atanasio, who's part of that large situation around PGA and golf.
Not to mention the Brewers.
Not to mention the Brewers. And so we have kind of every flavor of investing here. Of course, you guys are both going to be there doing massive conversations around AI. On the AI front, we have Coatue Philippe Lafont, who I don't recall doing an interview live in the 10 years that I've been here. And so that's a very rare interview, and sitting alongside David Rubenstein for that conversation, not just about AI, but also about how AI is playing out in the venture community, let alone public markets.
What exactly does he invest in? Private companies, publicly traded companies?
So both. And so remember, Philippe Lafont was one of the main investors who was one of the key crossover funds, right? So he was a big Tiger Cub public market technology investor, and he started, like Tiger Global, to invest in a lot of venture funds as well. Is that model alive and well? Are they doubling down in a downturn, or are they going back into public markets in a bigger way? Remember, we're having this conference also focusing on deals at a time where deals and IPOs, they've come back a little, but they haven't come back in full force. And so are things getting better from here? Or worse? We have an election cycle ahead, a lot of geopolitical uncertainty, so that outlook is going to be pretty critical.
Yeah, and it's still a pretty impressive lineup, Shonali. And of course, Bloomberg Invest always does it better than anyone else. Spread out over the next couple of days here, we'll have full coverage right here on the close, and in fact, across all of our Bloomberg properties all day long. So you want to keep your channel locked to right where it is here. Some great interviews up ahead. All right, let's set up, folks, for some of the other things to keep an eye on as well, Scarlett. And we're going to start off with one that I think is near and dear to your heart.
Yeah, tonight at 8 p.m. Eastern Time, Game 7 of the Stanley Cup Finals. And this is meaningful because Florida went to the finals last year and lost. So this is their second time around. The Oilers haven't won since the early 90s. And if the Oilers come away with winning, they'll have basically stolen it from the Panthers because they were on the brink of elimination and they won 3 straight. And so they'll see if they can win 4 straight. And Canada will get its first Stanley Cup since 1993.
I'm about to say, can we just give it to Canada? Why does Florida have a hockey team? Doesn't Arizona have a hockey team too?
Yeah.
What are they, Coyotes?
Well, no, it's moved to Utah now.
Okay, there you go. All right, Stanley Cup Finals, last Game 7 later tonight. As we were just discussing, also keep an eye on Bloomberg Invest, some big interviews. You might hear some interesting outlooks here on the economy and AI. I'll have a sit down with the CEO of Man Group, Robin Grew. We're also going to hear from the TCW President, Katie Koch, and SEC Chair, Gary Gensler.
What are you going to talk about with Robin Grew?
Well, we're going to talk a lot about AI, believe it or not. We're going to have her. That's going to kick us off early in the morning on the innovation stage right outside the thing, and that's going to set us up. I know there's a big interview I think Shonali has the next day with Todd Bowley. So this all is going to tie in kind of the big things really kind of driving the markets right now.
And that's what I love about this conference, right? It takes in the what's in the zeitgeist and really brings it back to our core audience of how are you utilizing this? How are you applying this? And how are you spending on this, right? All of that's going to come through in the next 2 days.
We also get some economic data as well, including a new read on consumer confidence, this time from the Conference Board.
Yeah, and of course this one, there's the University of Michigan one. This one's the Conference Board. Really key here as we keep getting anecdotal evidence that consumers are slowing down their spending. Retail sales was not fantastic. It showed that people were spending, but not to the extent they were before. And there's a lot of regional Fed business reports coming out. Philly Fed, Richmond Fed, Dallas Fed, Chicago Fed. Take your pick.
We're also going to get earnings tomorrow as well. Carnival coming out before the bell and after the bell. We are going to hear from FedEx. So a pretty good read, I guess, on what's going on in the economy, from discretionary spending to business spending. Join us tomorrow right here on The Close. Balance of Power coming up next. This is Bloomberg.